Good afternoon, and welcome to the European Industrial Logistics panel. The topic of the panel is, will yield compression continue and where do the opportunities lie? My name is Mark Cartledge. I'm a Senior Director at CBRE in the Industrial Logistics European team. And with me today, I've got Tom Sargent from DTRE and Dean Harrison from InfraRed. Gentlemen, Tom, would you like to introduce yourself in more detail?
Yeah, hi guys, I'm Tom Sargent from DTRE. I'm an equity partner of the company based in the capital markets team. So we are the UK's leading industrial logistics advisor based on capital markets market share. We're 34 people strong based in London and sort of do all aspects of transactional business within the industrial and logistics space.
And Dean, would you like to?
Yes. Dean Harrison, InfraRed Capital Partners. We are a global investment manager with approximately 12 billion of equity under management. I work in the European real estate team. I am responsible for industrial and logistics origination and execution. Over the last 4 years, I've been involved in approximately 1 billion of transactions, and latterly the 250 million pound disposal to Blackstone managed funds for our urban logistics platform in March 2021 that DTRE conveniently advised on, actually.
Thank you both. What we thought we'd do is start with a discussion of the occupational backdrop, if you like, the strength of demand that we're seeing for logistics space. So we saw record levels of logistics take-up in the UK and actually right across Europe last year, despite the pandemic. So how can we explain this, and do we expect it to continue into 2021 and 2022? Shall I start with Dean?
Yes. In the UK, online sales as a percentage of total sales increased from 10% in sort of 2010 to 20% pre-pandemic to 35% during the pandemic. So total retail sales. Supply chains for online shopping have improved significantly in the last 5 years through hub and spoke models, through retailers seeking to go direct to consumer, so whether that's sort of Adidas or Nike, or whether it's the growth of third-party logistics companies such as Clipper, DHL, Royal Mail. And that's meaning that it's now possible to receive same-day delivery at competitive prices for the consumer. In addition to that, we've seen traditional bricks and mortar retailers continue under severe pressure, falling revenues, high costs associated with physical stores. In 2020 in the UK alone, we saw 54 retailers collapse, affecting over 5,000 stores and over 100,000 employees. So essentially, the way I see it, improved delivery times, greater product availability, lower cost of goods now means that both consumer and retailer can benefit greatly from online retailing, further substantiating growth in the occupational market. I think when it comes to Europe, penetration rates in Europe are significantly lower, and therefore, there's a real growth opportunity looking towards Europe.
I think that's absolutely right. And last year, penetration in the UK went to 33. It's actually gone even higher in a couple of months this year. So we are seeing that elevated level of e-commerce penetration remaining quite high. Tom, did you have anything you wanted to add on that?
Yeah, well, I just think it's the continuation of a structural change in the market, and I think it was already happening from sort of 2015 onwards when the logistics sector really took off, and the pandemic has just sort of acted as a catalyst to that, and added further take up. But I think it's important to say it's not just e-commerce which is creating the boom in logistics. It is still all across all the other sectors, but I think it's important to now name Amazon as sort of one of the main drivers behind the change in take up. Being, I think there were 30% of all market take up last year. I don't know if CBRE have got slightly different stats to us, but they really are the sort of powerhouse leading the change across the sector, and requiring other retailers and third-party logistics companies to sort of improve their offering in order to keep up with the pace of change.
And it is remarkable given the economic backdrop, isn't it? I mean, back in the second quarter of last year, I suspect none of us would have expected the UK and quite a few European countries to have record levels of take-up last year. We were all wondering where the next deal was going to come from, probably. So it has been a remarkable turnaround. I think the question there is does that mean that with GDP contracting 9% last year, this link between standard economic growth has now been broken with sort of logistics demand. So it's actually more, it's driven more by other structural factors. What do you think, Dean? Does that make a lot of sense now, do you think?
It does to me, and I don't think there's really been a correlation there for quite some time. If we're taking a step back, we as InfraRed, our in-house view, we have identified logistics and industrial as an attractive investment class a long time before pandemic levels. I mean, we've been sort of going hard at it since 2012. Started with e-fulfillment centres, then down to big box, mid box logistics on key transport nodes, and then very much into sort of the urban logistics space. So that structural change was already taking place pre-pandemic. Looking forward, it's been accelerating, and I think coming back to sort of the penetration rates having spiked during lockdown, do we see them going back to pre-pandemic levels? No, we don't. So I think with taking into account supply and the huge uptick in demand, coupled with the weight of capital, I think it's fair to say that I think things are in a positive light here to stay.
I think that supply point is actually crucial as well, isn't it? Because yes, there's been record levels of demand in the UK and as I say, in some other countries last year, and it seems to be continuing into this year. But what's gives us a lot of comfort, I think, looking forward a year or so, at least maybe into next year, is that the supply dynamic is really nowhere near what it was 10 years ago. This is a much more constrained, much more managed supply environment. And certainly across Europe, I mean, I think it's also true in the UK, Europe, it's very, very hard to do speculative development. So, the funding isn't really available in the way that it used to be. So, and it's much more difficult to get approvals locally with municipalities. So, it's a much more managed picture that we have now in terms of supply dynamic, and that gives us a lot more comfort, I think, looking forward, that this sort of strong trend can continue. Do I add more on that, Tom? You're nodding.
Yeah, I was going to agree with yourself and Dean. I don't think the correlation was ever that strong. I think we've moved to a new era where warehousing sort of much more closely aligned with retail spend rather than sort of manufacturing or other sectors. And I think 2020, the pandemic wasn't a sort of normal economic event. It's very much a black swan event, and I think what the sector has demonstrated is its resilience and how important logistics is in the technological and sort of data age that we live in.
No, absolutely. Yeah, and I think we would expect that to continue into this year. The demand trends, as I say, the supply trends are very positive. Vacancy in the UK is now 4.5% or so. And that's similar across Europe, actually, and there are markets in Europe where you've got vacancy of 2% and below. So, the often very, very tight markets, which hopefully for investment attractiveness is very positive in that it should lead to positive rental growth looking forward over the next few years. Do we have any view on where we think internet penetration can go in the UK? I mean, obviously we saw it reach 33% and last year, and then up to 35%, I think, or maybe even higher in the last couple of months. Is there a sort of target or a limit to think? I've seen targets of 40% for China, so presumably we can get there too now. It doesn't seem like it's an unrealistic target anymore. Dean, do you want to start with that?
Yeah, sure. What I would just add on the supply point, I think as an investor looking forward, one area of concern is very much on the big box, where you've got sort of not unlimited amounts of land, but these sheds can be knocked up very quickly. Now, I do think there is significant demand, certainly outweighing current supply levels, but these sheds can move very quickly. There's a lot of big schemes coming through. And if we start thinking about future rental growth performance, it is an area where, I'll have a keen eye on that dynamic, and we'll come on to it in due course about where we think future opportunities lie for outperformance. In terms of the penetration rates, I can't sit here and look into my crystal ball and put a number on it. But if we think about the reasons that we suggested with regards to retailers going direct to consumer, which I think is a new big trend that's taking place, the ability now to offer consumers really competitive pricing and getting it to your door on the same day is just added a whole new convenience factor. So I think at the minute there is enough operational demand that's saying we will continue to push penetration rates north. If we look at the historical growth rate, pre-pandemic levels, it was slowing slightly down from 20% down to sort of 15%. So I think what I see is, let's say it got to say 35% during the pandemic. Let's say it comes off a bit. Maybe it comes back down to 30, but then what I see is those historical growth rates continuing, still very much double digit growth. So I wouldn't be surprised to see it get well into the 40s, and I think it's very difficult to start sort of looking beyond that.
No, I agree. And I think the other thing to recognise is that there's been an increasing capacity to service customers, hasn't there? Not just in logistics, but also in terms of delivery models. Especially for grocery, where penetration levels were about 5%. E-commerce activity was about 5% of the total grocery sales, and now it's jumped to 10 to 12%. And it's remained fairly static over the last few months. So you'd think that actually the capacity to deliver those groceries now is much increased, whether it's using other models that rather than sort of copying the sort of Ocado model. So yeah, I think that supply side angle has been much enhanced, I think, during the pandemic. So that should again help that process of increasing e-commerce penetration. You're nodding again, Tom? Do you want to add something there?
Yeah, well, it's I think it's forced people into adoption. And one of the reasons behind the growth being held back previously was the sticky barriers to adoption. It's not just young people using their phones to buy stuff anymore. My 89-year-old grandma orders like 3 things a day on Amazon Prime, and now we've overcome those sorts of sticky barriers to adoption. I don't see why there is a ceiling to the penetration of e-commerce. I think we'll sail through 40 and it'll be 50, and within the next 10 years.
Yeah, I saw some figures actually that if you take out grocery, then it is already 50% for the other sectors.
Yeah, if you look at some of the grocery stats which have grown this year, I think I'll read them out. But John Lewis, Waitrose.com sales have grown 4-fold since Feb 2020. JohnLewis.com sales are up 73% and are now 75% of their total sales. Up from 40 in last March. That's massive growth.
No, absolutely. And what it's driving, of course, is sort of technological change within the warehouse and obviously within the whole sector, but within the warehouse. And clearly these fulfillment centers, you can actually have as much invested inside them as in the actual building itself. So that's a process that can only continue, I would imagine. How much further is it to go on this? Obviously there's been quite a lot of automation already. Can we see that increasing further in the future?
Yeah, I think Prologis research has suggested that sort of pure online fulfillment requires about 3 times as much as logistics space as bricks and mortar retail does. That's because all the inventory has to be stored within the warehouse. The digital storefronts offer greater product variety, so there's a deeper back catalogue of what they're keeping in store. There's higher volatility in sales patterns. Parcel shipping requires more space than shipping pallets, and many of these operations include returns as well, which is sort of part of the market which obviously gets forgotten, but has considerable expense. So I think taking all that together, the intensity of use generates significantly increased demand. And I think if 2020 saw 30 million square foot sort of pure play e-commerce demand in the UK, for that to grow in the same rate as this penetration, you'd need another sort of 76 million square foot a year by 2025.
I mean, these are massive numbers and they're hard to get your head around often, aren't they? But yeah, so last year the UK take up was about 42 million square feet. So we're talking about nearly 2 years of extra demand, basically, potentially that would be required to service that e-commerce growth. And that's just the e-commerce growth, of course. Yeah. That's not the rest of the market, and e-commerce is about 30% of the total. So yeah, the potential for growth is huge. The interesting thing, of course, is that actually the bigger e-fulfillment centers still employ a lot of people. So you kind of think that they're very automated and therefore, there's not many people working in them, but you can have 4,000 people working in shifts on a big Amazon unit. So, will we ever go to, the laborless unit? I don't think, there are 1 or 2 in China, I believe, but I don't think it's likely to happen in the near future here, is it really? What do you think, Dean? Is it? I mean, this automation and this technological revolution will continue, but it's not necessarily going to reduce the requirement, I guess, is it?
No, I don't think it reduces the requirement. I think what I find quite interesting is some of the technological revolutions that have taken place just with regards to the consumer. So how easy it's now becoming to just basically order anything that you want offline, online, sorry. And new markets sort of entering into this space as well. It's not necessarily logistics based, albeit like the uptick in, say, dark kitchens. So Deliveroo has been absolutely huge. I mean, I'm guilty of sort of being, spending too much time on Deliveroo myself. But what you're seeing is the traditional urban logistics estate, not necessarily the big box, but now the plethora of uses that are taking place on that estate. So relative, whether it's dark kitchens, whether it's gyms, whether it's business to business online or business to consumer. But what you are finding is that some of these tenants, so particularly, whether it's a dark kitchen, whether they're paying £10 a square foot, 15 or £25 a square foot, actually they're pretty small numbers and they're not particularly price sensitive. But the knock-on ramifications for valuations on these estates, particularly if you're setting new tones, can be material. And this is clearly one of the reasons why you're seeing total capital growth or total sort of shareholder return coming through.
No, and that's why you've seen so many investment strategies targeting this area. Blackstone being the obvious one with Mileway, but plenty of others that are targeting this area. And maybe that neatly moves us on to where
I was just going to say, there's been a lot of chat about drones. I'm not quite there yet, and I know it's being pushed, and I know occupiers, particularly the likes of the Amazons. I mean, it appears to be a bit more than just smoke, but I don't know. I'm still struggling. Is it something for maybe 2030? That maybe feels right. But I can see that there's going to be an awful lot of red tape that they've got to get through, and I don't see it really having a material impact on occupational demand. I mean, I suppose the argument might be that people need less space because they can get things to the consumer quickly and more frequently. But I don't see any sort of immediate impact as a result of that.
Yeah, actually, we do an occupier survey once a year and across Europe, and would include people like Amazon. And one of the questions was, which technological developments do you see most likely to change your business or affect your business over the next 5 years or whatever? And drones, I think, was bottom. So, and that would include Amazon. So within those numbers, so yes, it's something that gets talked about a lot. It's a very kind of hot subject, but the practicalities of it, I think externally, maybe internally for stock checking and that kind of thing, but actually for the longer term, it's, as you say, probably a few years away yet. And maybe we kind of move on to the investment angle. Actually, it might be a good opportunity to talk about where we see the opportunities. Yields, and we're talking here about prime logistics, really, I guess, mostly. And we can talk about other parts of the market, but let's just say we're talking about logistics. Yields have compressed. The spread over other sectors has narrowed significantly. Especially across Europe, actually, retail's obviously, retail yields have increased, so that spread's either narrowed or inverted. And over offices, they've narrowed a little bit as well, most recently. Does that mean there's fewer opportunities, or is there still a lot of opportunity for logistics investors to generate good returns? That's really the question, I guess.
Do you want me to start with this one?
Dean, go ahead.
Darius, I think we've got a slide that will sort of help give us something to talk to. Slide 3 of the deck that you've got. So perhaps we can have a look at this. So what we've got here is net initial yield, all property Europe. So first of all, let's just make a note of that it isn't necessarily prime logistics. And then we've got sort of 10-year gilts, which at the moment, my understanding is about sort of 20 basis points. So we've got a material spread, and what we can see there on the grey line is that spread. And if we sort of go back to sort of basic principles, we start with that risk-free rate, and then we ask ourselves, well, what is the risk premium associated with investing in real estate, namely being sort of liquidity, and taking into account that it is very much that all risks yield. So if I just take sort of a step back, I would say last sort of 12 months, it feels to me that yields have sort of compressed about sort of 75 basis points. What I would say is if we take an example, and I know Tom's aware of this. I think you may have seen a deal recently. It was an institutional investor buying 500,000 square foot Amazon Shed, 20 years, RPI linked, 20 years fixed, about a 3%. Now, if we think that actually yields are gilts are at sort of 0.2%, and we look at what that historic sort of long-term spread is, I mean, looking at it optically, it looks to me sort of 3%. But that's factoring into account all property. So for me, sort of 280 basis points over a gilt still feels like there's a little bit more to go. If you cast your eye to the continent and you start looking at German offices and appreciate their sort of off Euribor and actually their rates are negative in a lot of cases, you're seeing German offices trading at sort of 2%. Okay, it's super prime, but it's still 2%. So I think for me, yes, there's a little bit more yield compression to come. A lot of it is very much subsector specific. And, we can start talking. It's very easy to compare long income. I mean, almost to the extent, at what point does it stop becoming logistics, and does it just become an income strip based off an Amazon covenant, and you're essentially just buying out Amazon debt? So I think if we're focusing our attention to that end of the market and we're looking at post-COVID winning covenants and long-term income, these spreads still look quite attractive. They're pretty dry, and it's a pretty not opportunistic, but it's quite a speculative view to try and turn double-digit returns out of it, because you're saying, well, I just back that spread is too wide, and it's going to narrow. I think for me, the big elephant in the room, and there's a lot of talk about it, is inflation, because you're buying something, it's 300 basis points spread, but what happens if we get increased interest rates, which should be a reaction from the government as a result of increased inflation? But I think when where we look at in the current climate coming out of COVID, I can't see the government being able to do that. I think they're in a bit of a rock and a hard place, to be honest. You've got consumer debt that's sort of record high, and when I say record, I'm taking into account mortgages. You've got a lot of first-time buyers that are getting on the ladder. They're not fixing for 5 years, typically fixing for 2. They're 95% geared. You've then got government debt at record levels, and then you also have to remember that inflation acts as quite a nice little tool for the government to reduce the debt ratio to GDP. So actually, in my mind, I think the short to medium term, I can see rates staying low for long, just by a function of the government not really being in a position to increase them. If you look at the sort of forward curves in the swap markets, they're not talking about a price, an interest rate increase for a couple of years, notwithstanding I don't find them particularly useful tools because they can be very, very volatile. So if you're of the mindset that we are in a low interest rate environment, for a long period of time, which I think I am there for a minimum of sort of 5 years, and you're looking at these spreads which are above the historic levels, and to me instinctively feel very attractive, then yes, I do subscribe to yield compression for the right kind of product.
No, I think there's a lot of very good points in there, especially talking about covenants and length of leases. These things obviously have a huge impact on the yield, for a particular investment. And I think on the general point about inflation, clearly in the US we've seen significant increase in yields because the economy is way ahead of Europe in terms of its recovery. So I think Europe is still, and to a certain extent the UK, a long way behind what's happening in the US. So that the fear of inflation and then rising bond yields is probably, as you say, a couple of years away at least. And certainly on the short-term interest rate front, I think we have, our forecast is 2023 or 2024 before we see any increases in Europe or the UK. So we do. It does seem as though there's a long way to go in terms of rising interest rates, and therefore that spread should be maintained for the foreseeable future. And that is what is attracting the majority of the capital from partly the investors have always been there, but also the investors who are switching out other sectors, or certainly were last year, because retail was difficult to invest in, and perhaps even offices were becoming less attractive. So it does seem as though the backdrop, the macro backdrop, is set fair for the foreseeable future. I don't know if you, Tom, had anything you wanted to add on that.
Yeah, no, I was just going to agree, and ceteris paribus, assuming what you guys have just said, everything remains the same, then, the weight of capital, targeting the sector is, completely unprecedented. And I think, solely for that reason, yields are going to continue to press. Just as competition is so strong for each asset which comes to market. There's tens of billions of global capital targeting UK logistics, and the market's only about 5.5 billion a year. So, just on simple maths, the supply and demand is there. The pricing is going to keep increasing just as people sort of, tweak their underwrites in order to get access to stock.
Yeah, I think there's a small another nuance to all of that as well. Where they're big sheds and occupiers are wanting to amortise their fit-out costs over a long period of time, they'll sign the longer leases. If you're putting in place the RPI, and even better if you've not got the floors and the cap, but if the RPI is in place and you've got institutional investors that have concerns about inflation and wanting to ensure that they've got a level of inflation protection, I just see that, first of all, the weight of capital, 2, the inflation protection you can get through some of these longer term leases, and 3, the spread over the risk-free rate and the low for long interest rate environment, to me feels like there is more to go on the yield compression. Of course, when we start moving away from these brand new shiny sheds for 20-year leases and inflation protection, and we start moving more towards, say, multi-let, secondary kit, that requires asset management, that doesn't have any inflation, implicit or explicit inflation protection built into it, then it becomes slightly more difficult to join the dots. Notwithstanding, I do feel that there's an element that this particular sort of big box logistics, that sets a marker in the sand, and there's an element of other kit being priced off it. So if you say that the big box long dated logistics compresses 50 basis points, there's an element that there's certainly an overflow of capital, and that yields across the other subsectors of industrial and logistics certainly seem to follow suit.
Yeah, and actually I was going to make a point on the UK investment size. You were saying it used to be kind of 5 billion. Well, actually, it was 4 in the first quarter this year. So maybe we have to rethink the size of the market in terms of the.
So that was logistics.
Yeah. But yeah, so in the first quarter we saw 4 billion euros actually, so less in terms of pounds, but and that's following on from I think 5.7 or so in the fourth quarter of last year. So clearly the market is extremely attractive to investors. It's there's a lot more stock suddenly available, which probably was part of the problem at some point last year. So that and I think generally across Europe we've seen very strong investment volumes actually. Actually, I think for the first quarter we saw 3% increase in total for Europe on what was a very good first quarter last year. So that just shows you that the sector is still attracting a lot of capital, from globally, and from not just Europe or from local markets, but also from Asia, from North America. And that is part of the reason that we're seeing these yields being driven down. And perhaps in certain instances they can go a little bit too low too fast. I mean, we had one deal in Netherlands recently which was reported just over 3%, and that has certain concerns for some investors. Am I going to have a chance of getting anywhere near these assets if that's where yields are going? So there could be a correction mechanism potentially within that, which does put some investors off potentially. But as Dean was saying, it's partly do you want this long income with inflation protection and with extremely strong covenants? And if you do, then eventually you're paying a core price for what is core product. So actually,
I think there is another school of thought as well, and rightfully or wrongfully, investors, even with the short-term income, they just turn to rental growth. I think I think the sentiment in the market in sort of this COVID or post-pandemic world is that the rental growth prospects have certainly increased, and that certainly implies where there's a shortage of availability of land. We'll come on to it in a bit. Urban logistics. And where that is the case, it's much easier to justify lower yields. I mean, you could go back to sort of 2007, where actually there was an inflection point because everyone was saying it's okay, it doesn't need to be a risk premium because I'm going to get it through rental growth, or I'm going to get it through capital appreciation that's inevitable. So I think there's an element of people being able to justify lower yields off the back of for forthcoming rental growth that's been accelerated through the occupational demand as a result in a post-COVID world. But of course, as an investor, you do need to be more discerning because it's very easy to get caught up in that mentality.
No, we've definitely seen that rental growth picture. It's been very strong in the UK, and it's starting to hit the European markets now. It's quite lumpy, but you do see one market in Germany suddenly has a very strong year, and then it has a quiet year, and then another market shows a lot of strength. So it is coming through. It's been a slower process, but given where vacancy levels are, you'd think that would be a longer term trend now. And perhaps it's been a little bit of a cultural obstacle that a lot of asset managers haven't really pushed rental growth. They've been pushing occupancy, and it's been the target. I don't know whether you've seen that in the UK in the past, but it's certainly a factor we've seen in Europe, I think.
Also, yeah, no, completely. And I think that's now going to be the big inflection point where it's gone from being, you've had almost 15 years of it being a very tenant-friendly market, where it's now a very landlord-friendly market. And, the increase in occupational demand versus the lack of supply is now, leading to proper rental growth. And because the way the investment market is and everyone's pushing their underwrite assumptions, it's no longer sort of Mr. Friendly Landlord, I've got, you've got 5 building options for one tenant. It's the other way around. And you go, this is the rent, this is the term, take it or leave it, and there's nowhere else to go. And, we're starting to witness that relationship change between landlords and tenants, and they're no longer, customers. Is actually becoming this is my building. If you want to take it, here are the terms, or off you go. And that's, we're now seeing, 50% rental growth in single years. In core London markets because of that switch in relationship in the last 12 months.
Yeah, there was a very strong comment from the CEO of Prologis a couple of weeks ago on their earnings call, where he was basically saying, don't ask for any. Well, actually, we know the tenants who were asking for rent holidays last year, and when it comes to it, if there's a competing tenant for that building, we're not going to give it to you. Let's say,
we've got long memories.
The other competitor. So we're well aware of the tenants who were trying to make use of the situation last year, and now that the market's so tight, and I think he was mainly referring to the US, but I think in a global context probably. Yep. There's a lot of demand for a limited amount of space, and therefore they're going to be pushing rents very hard. And I think their forecasts, I can't remember the exact numbers now, but they were pretty aggressive in the sort of high single digits for rental growth across their portfolio.
I think just sort of, I know we talk about it quite a bit at Infrared, is it's so key though when looking at the underlying the subsector of the industrial side. We're typically, less bullish on smaller units of say 5,000, where the tenants are more SME driven, and therefore I think that correlation to GDP, it is still very prevalent. You are going to see more administrations, the covenants, more sort of mum and pop covenants, and coming back to the units that are going to perform well: big yards, big eaves, modern spec, land constrained. Basically what you can put and coin into supply chain logistics, because that's ultimately where the sheer amount of demand is coming from.
So therefore, it's not just big box logistics where we're going to see the performance. We are going to see that performance continue in the sort of, let's call it urban logistics, let's call it a mixture of light industrial and urban. So you would still be a strong advocate of that part of the market, even though we've seen very good rental growth in that.
Absolutely. I mean, that's where I see the outperformance. I see it in the sort of 20 to 50,000 square foot units. So if you think how occupiers go about putting in place their supply chain, the traditional sort of hub and spoke model, they typically start with the hubs and then they work down to the spokes. And we see it, Amazon e-fulfillment, million square foot, then down to the 250s in the regions, and very much active in the 50,000 square foot space, say UK top 20 cities. We saw this in our own Vantage platform, and we did two deals within Amazon in the last 4 months, just before we sold in March. Both units 50,000 square foot. And of course, to sort of further support the rental growth story, it's chimney pots that are surrounding these units, and these units have to be within a 20-minute drive time to CBDs. So what you've got there is lack of competing supply over future years, where you should be able to really drive those rents forward.
Yeah, and in markets like London, you're losing industrial space every year. So how do you replace? Well, you can't replace a lot of this stock, or you can't increase the quantity of this stock. So what does that mean for prospects for rental growth? Well, they can only be upward, can't they? Really, I mean, certainly in most UK cities that would be the case, I would think.
Yeah, well, it's I think Prologis famously stated that rent as a total cost of operating a logistics facility is between 4 and 6%, depending on how big the unit is. And if you extrapolate that out, rents can easily double, and you still afford to run that space. It's other costs within the supply chain which have the margin squeezed on them. But like Dean says, I think it's the urban locations where someone has to be. I think if you offered Amazon, a DC in Mayfair, they'd pay you 100 quid a foot happily for it, because it doesn't exist, and it can't exist because of higher value other uses. But they still need to be in these core markets where people live and they're delivering to. And I think we'll see massive rental growth in key urban locations. I know you mentioned a key deal in the Netherlands which has sort of shaken that market, but I think British Land buying the sort of Waitrose and Crown Records unit in Enfield recently for 2.1% has sort of completely blown the sort of urban logistics market open in London. It's a building which is currently rentalised off, I think one unit's 7 quid, one's 9. You're forecasting it might go to 15 at rent review, and investors go, nah, it's going to be 20. You're doubling, more than doubling the current rent in 4 years' time, based on nothing other than sentiment.
Yeah, and it's happened in the past. I mean, maybe more centrally, I remember there was one in Battersea that was on, I think it was about 10, and it was acquired by I think it was Blackstone, and then they went to 30. So these are trends that have been seen elsewhere, and clearly that's much more central. But these are trends that are being copied from other regions. So yes, I think it's clear that the urban space, if you can get it, is a great area to be investing in. And I suppose that's true across Europe as well, though it's mainly in the larger cities. It's really the bigger cities that are really being targeted by the occupiers, I guess. Some of the sort of more regional cities are probably not quite so attractive from that perspective. But certainly Amazon is building out this region-wide network, so it'll be targeting everywhere to be able to deliver that offering.
That's it. What you guys advise them. I think Simon's got requirement for 27 AMZLs currently live in the UK at the moment.
And just to clarify, AMZLs are the Amazon logistics buildings, which are the urban fulfillment centres, if you like.
Those have lots of parking, electric vehicle charging.
Yeah. No, it's I mean, across Germany as well as the UK, that it's a big sort of rollout of this capacity. And generally investors are keen to take them on board, and obviously got lots of development partners. And although the yields are being pushed very low for some of those, a lot of them are on extremely high rents as well, which has to be explained because of the fact that they're obviously very central generally. They have very low site coverage, because you've got all these vans having to get access to them, and obviously you need a lot of parking as well, because of you can often have hundreds of vans going in and out of these buildings every day. So they are quite unusual buildings from a lot of perspectives. And then you have to have the charging points as well. So they are being rolled out very aggressively by Amazon. But it seems at the moment there's good good demand from the investor community so far. So that is certainly an opportunity that is being taken up by investors, and I think it's one that will continue to be strong for the foreseeable future. So we were talking about the opportunities, and because obviously yields are so low, and probably likely to further compress. And we talked about urban, and we talked about logistics. Maybe multi-let we haven't really talked about so much. Is that an area that you see more demand and more opportunity as well, potentially?
I think so, because I think these supply chain logistics absolutely form part of multi-let estates. At InfraRed, we've got a dedicated urban logistics income fund. It's sort of 10 years focused on, very much on the distribution yield, but we nevertheless are very much IRR focused. And I think that, and it is consistent with, we're in the right place with the money raised, with the strategy that, we definitely conform to. But I've put down here sort of 15 to 75,000 square foot units. Now, they are unit sizes very much typical of multi-let industrial estates. And the good thing about multi-let is there's normally good opportunities in the income profile. You get tenant churn, the ability to access reversion, the ability to refurbish. I think if you can couple those unit sizes which match with the occupational demand, you've got to make sure that you're getting the spec right. So it needs to be high eaves, low site coverage. That's certainly something we're seeing. People want big yards because they've got these more vehicle movements now. It's not a manufacturing facility where people turn up to work, park the cars, go in and work and leave. They need 24 access, and they need plenty of yard space. And again, it just comes back to being land constrained. If you're acquiring around the M25 or within 20 minutes drive time of UK top 10 city, that is one of the key criteria that our investments have to meet. Again, I think you will potentially it's upside potential with downside protection. I think is the way I would put it. I think cold storage looks potentially interesting, just because we've seen this huge growth of grocery, food, and online delivery. Albeit it's pretty high barriers to entry. It's something that we're looking to explore a little bit further, but it's not completely obvious to me. And I think something else that's really interesting. It's really important that as an investor, you're paying attention to ever increasing occupier requirements. And Tom, you picked up on it, EV charging in Amazon. We just completed a 50,000 square foot brand new unit pre-let to Amazon. And one of their key points was, it's UK top 10 city, they want all of their fleet to be EV. They not want to be, it's going to be, they're all going to be electric vans, because it's 20-minute drive time to city centre. The battery life on the vans is ample for them to complete the trips that they need to compete, but they need storage space and they need charging space. So there's a separate conversation taking place about some bare land next door where it'll include a facility for the EV charging point. And again, I just see these trends continuing. So I think it's very much, paying attention to occupier requirements. It's not just a case of a box anymore. There's certainly becoming more bespoke requirements, and actually seeing occupiers stepping into the space, building their own facilities more and more commonly because of their bespoke requirements.
And then the power becomes even more important, doesn't it? It was always important for these buildings, especially with all the automation internally. And then if you've got charging points externally as well, it becomes even more of a concern. And I think that can only increase in the future. And it's not just data centers that need a huge amount of power, it's also logistics buildings or even urban logistics buildings.
Who are now having to compete with data centers who, can afford to pay more per acre or per square foot than an industrial occupier. And it's, it's squeezing us from the other end that Resi was once before as well.
Yeah,
no, definitely.
That's the other good thing about the urban logistics story. More often than not, the investment value is so heavily underpinned by alternate use value. So whether that be residential, or typically residential, particularly in London, for example, there'll be an inflection point at some point, but we're still quite some way off that at the moment.
Although I think there'll be probably more of the combined use buildings, perhaps to maximise the opportunity for residential and well, maybe not call it industrial, but maybe call it delivery solutions within urban centres, because otherwise, how are you going to have enough enough of this storage space within city centres to actually satisfy the consumer demands? It seems very difficult to envisage, really, in the longer term, unless there is land set aside or created even for the purpose, within certain big developments, that are happening within certainly in London, for example. We talked a little bit about other solutions for grocery, and I think what I'd always assumed was that grocery would become, would grow in terms of penetration the same way that other sectors have, and it would be, therefore we'd see this huge investment by the main supermarkets to sort of replicate what Ocado's done potentially. But it seems like that may not happen, given the other solutions that have sort of grown up or emerged during the pandemic, with the likes of Getir and Stuart and delivery being used for grocery deliveries, etc., etc. Could that sort of have a dampening effect on the demand for some of this urban space, do you think, in the longer term, for grocery delivery not really coming through in the way perhaps it might have done, under other solutions, other ways of delivering groceries in using the Ocado model? What do you think? Is that?
I think from my experience when looking at these things, comparing a dark store to what Ocado have done, it's the main barrier to the other grocers adopting the Ocado model or buying the technology is literally cost. And I think Waitrose recently did the exercise of understanding how much it would cost to turn or either get new facilities to be able to compete with the level of demand they're getting for the online groceries versus what it would cost to utilize stores to do it. And they worked out that I think it was like 200 million per single unit investment it would have to be for what it would replicate a dark store on. And do you know how many staff you can hire to pack groceries for online shopping in a shop for 200 million per asset? And they just decided that it wasn't worth the investment for them. It wasn't going to pay off. We've certainly seen Tesco's, Asda, Sainsbury's, rather than expand their logistics footprint, they are just utilizing stores more for online delivery because it's already there, it's already laid out in the aisles. You've got plenty of parking even in the urban locations. And the vans can pull up and pack bags and deliver it straight to consumers' houses without actually having to invest anything in your supply chain. And unless the cost of that capital expenditure reduces significantly, I can't see there being a massive increase in new take up for any of the grocers in order to change that.
No, that seems to be the case, isn't it? And yeah, I think unless people aren't prepared to pay the high fees that they were paying during the pandemic, I suppose that's the question, whether you might be prepared to pay a big premium to get your groceries delivered when it's more of a hassle to go to a supermarket. But perhaps when we're back to normal, hopefully, that may not be quite so attractive. But so that was I thought I had a question there that didn't come through actually. There was one other thing we didn't touch on yet, and I think it was within one of your charts actually, Dean. So maybe we should touch on that. Looking at the listed space, so the REITs and the listed industrial stocks across Europe, I think you have a chart on this, basically comfortably outperformed all other sectors over the last year. And obviously, that's because the industrial sector, was one of the main beneficiaries of the pandemic in many ways, and therefore the REITs performed very well as a result. I mean, do we think that's likely to continue as other sectors start to recover, and perhaps we go back to offices in more concerted numbers, and people start to lose their concern about the office sector over the longer term, and who knows, retail maybe even has a bit of a recovery as well, and certainly leisure should have a recovery at some point as well. So is that likely to change, you think, in the longer term or medium term?
Darius, could you just turn to slide 2 on the deck? So if you just exactly. So okay, so just looking at the question, I think, what is this chart showing us here? I think, and I better quote the source actually, it's Royal Bank of Canada. It's not infrared proprietary information, but look, I find looking at the listed markets, super interesting in terms of gauging sentiment. Yes, they overcorrect. Yes, they go up too much and they go down too much, but they certainly give you an indication of where things are. And what we can see here is the last 12 months, industrial being, very much the outperformer. Now, that's looking over a 12-month period, Jan to Jan. If you look at the latest 12-month period, actually retail is the top performer, because markets had, fundamentally, what's been driving this pricing is the occupational market of each subsector and everyone's interpretation of, how is the pandemic impacting that particular sector. Now, to begin with, retail, it was almost everything was priced to fail. A lot of the stocks became penny stocks. So if you look at it now from April to April, you'll see that retail is the top performer in the last 12 months with a 40% gain. Now, I think if we look at, what about the outlook for industrial performance? Well, they say, let's take Tritax and Segro. They've got them down at trading at sort of premiums of 5 to 15%. But I think there's a real key point there is these metrics lag comparable evidence. Tom's got his finger on the pulse. We all have, because we're seeing the transactions live. by the time there's comparable evidence and rental evidence and that, and investment yields filter through to the REIT valuations, I think to me, there certainly feels like, these assets are probably trading more like par. Okay, so I think that's a key point there. In addition, SEGRO and Tritax, they've got really good development pipelines that are quite well advanced. They're not particularly immature as well. So I think, instinct would tell me that pre-letting activity and rents and lease lengths that they'll be signing during this development period are going to be well outperforming business plan. So I think for me, risk-adjusted return, industrial still feels like a safe bet. I think new yields have been set in the last 3-6 months. I think they'll come through in valuations. I think the development pipelines will come through, and you get a nice dividend yield, and I think they'll perform just fine. Whether it's 10 to 15% over the next year. Actually, I don't know that, but instinctively, it wouldn't surprise me if that's where it is. I mean, when we look at office, I still think there's a huge cloud there. What is the fallout from COVID? When you talk to occupational agents, they'll tell you there's a huge amount of grey space coming to market. Occupiers giving back space that's leased, putting it onto the secondary market. Well, that only suggests one thing, and that's ERV declines. Yet a lot of these listed vehicles with high office content, whether it's British Land or Landsec or so forth, trading at huge discounts. I think there will be pockets that will perform well, Helical, in particular Derwent. I think the product that Derwent produce, with high levels of amenity space and a real focus on well-being, and the White Collar Factory springs to mind in London, where they've got a running track on the roof and so forth. I still think there'll be huge amounts of demand for that. So, it's really difficult to know at the minute. That's reflected in the investment market. That's reflected in the discounts. If retail is going to perform, it's because it was priced to fail and it's managed to survive, and therefore investors, could do quite well. But from a risk-adjusted basis, for me, industrial still feels like a strong bet, and that's where my money would be for the short to medium term.
No, I would tend to agree. Actually, I think even as you say, the dividend yield is actually still pretty good for most of them. Certainly in the sort of 4 to 5% range.
Well, completely. And this comes back to interest rates again, doesn't it? You're seeing a lot more retail investors getting in. Hargreaves Lansdown reporting such a huge uptick in retail investors opening accounts because what they're getting in the bank, they're getting nothing. And actually, you can buy Tritax and was paying 4.5. It's now more like 3.5. But you know what? 3.5 sounds pretty decent when their WALT to break is 13 years and the biggest tenant is Amazon. You're buying Amazon debt. Still feels attractive.
And actually, they came out with quite a positive trading statement. And then the Eurobox part of Tritax has also been very aggressive in the market, made some very large acquisitions recently, a couple of very big deals in Germany. And that's also a very interesting vehicle for industrial investors. It's becoming, and it's now reached a size they feel that they can get much cheaper debt, so that enhances their returns as well. And so then becoming more development orientated as well, in the way that the big box in the UK is.
We have started looking more at Europe for sure. We found two sort of issues. We did quite a bit in Paris. The quality of the kit. It's really difficult to get your hands on what we would consider today grade A specification kit. There's just a real lack of it, and, partly because of developers or planning and so forth. And then as we start to look further abreast in terms of supply chain logistics, the yield spreads look really attractive. You might get another 100, 200 basis points in places like Spain. The problem is those gaps are closing, and they're closing and they're almost gone because of the weight of capital that's coming in. So I think we're going to have challenges deploying.
And then quality of kit is also a similar point in Spain as well, and Italy as well to a large extent. There's a lot of old kit around. But yeah, you're right. And the yields in Europe, because they've gone so far, fallen so far in Germany, Netherlands, to a certain extent France, people are focusing more on Italy, Spain, yields converging there as well. So there's going to be a point where the attraction of these other markets, the sort of Mediterranean and Central European markets, it becomes no greater than the core markets that have seen such yield compression recently. Did you want to make any points on Tom on the listed space, by the way? Just while,
no, completely agree with what both of you have said. Nothing to add on that.
Yeah, and I think we obviously talk about the likes of Prologis because they are listed and they give us a lot of information about the market in general. But I think the European listed space is now of a decent size. It's obviously, as Dean was saying, generally trading at a big premium. Some of the Europeans actually huge premiums, the likes of VGP and WDP in Belgium. So I wonder how sustainable some of those are potentially. But yes, in general, good performance on a year-on-year basis, and you would imagine that would continue for the foreseeable future. I don't think we have any questions lined up yet. So if anybody does want to ask a question, please do either put your hand up or type into the Q&A box, and we'll be very happy to address them. But I don't think we have anything lined up unless I'm missing it. Can you guys see anything there?
No.
So perhaps just maybe a couple other things we could touch on. We talked a bit about, obviously, a lot about yields and potential for further compression. I mean, I suppose the comparative yield is, we talked a little bit about that with Germany, didn't we? In terms of office yields versus logistics yields. I mean, in the UK, they actually got very close, didn't they? So I think because there was obviously a lack of investment in the office market to a certain extent because of Brexit, office yields pretty much stagnated. So there's no reason why logistics yields can't converge on office, can they? I mean, it's probably about 100 basis points, 90 basis points across Europe, but in the UK it got very, very tight, and so that does give, I think, investors some comfort that that's potentially something that could happen again in the future. Would you agree, Tom?
Yeah, no, I would completely agree. And subject to the debt markets saying this the way they are, I think we're going to continue to see the compression across the industrial space. I think from the occupational perspective as well, going back to logistics and sort of the prime sector and longer leases, I'm not an office specialist, but I'd be surprised if there was many large occupiers signing long leases on prime buildings going forward. Certainly not until we've got greater clarity on how people are going to utilize offices and what that investment means. Whereas we're going to continue to see it regularly across the industrial space, and therefore I think pricing is going to continue in that market and drift out on the office sector.
Tom, I think you make a really good point there that we didn't touch upon: debt markets. And it's not just the amount of equity, it's the amount of debt. Debt funds, banks, they still want to lend, they still want to do business. And particularly if you're a debt fund, then that's your only line of business. So what we saw is we were coming out of the pandemic, or the early stages, both banks, equity and debt, taking confidence in the industrial and logistics sector. And therefore there's huge competitive pressure building from the debt side, lower margins. So again, it's sort of just fueling the fire further, I would say. So funding is very much there for spec development on the industrial side, but I think you would struggle to find it, on the office side or the retail side or any other sector. And I think it comes back to your point, Mark, then, why are all these asset classes diverging? I mean, if you go back 15 years, industrial was it was the outlier. No one wanted to be associated with industrial, everyone wanted to be associated with shopping centres, but a combination of the equity and debt chasing the sector is completely driven pricing one way and outwards for others.
Yeah. Well, I think the yields have still got some way to go in Europe based on that, because you can borrow against a long let to Amazon at 80 bips, whereas it's you can get 180 here. So if we've got 100 bips spread in inflation from the continent to the UK, and we've still got pretty closely matched yields, then that would suggest that pricing still got some way to go for the best quality kit in Europe.
No, definitely.
Yeah, agreed.
It's definitely enhancing returns. We've got a couple of questions. So firstly, first question is anonymous. It says, how do European listed real estate companies differ from US REITs? Are tax incentives and return obligations the same? Does anyone want to have a go at that?
I don't have a clue.
I don't know about US REITs particularly, but generally, certainly in the UK, the requirement is you pay out 90 to 95% of your property income as a dividend, and therefore you don't pay corporation tax as a result. So I think the US regulations are slightly different, but that's the case in the UK, and generally the Europeans have similar type of arrangements. So yes, it's generally, there's a trade-off by paying out the majority of your property income, your rental income, as a dividend. You avoid the corporation tax. We have a question from Michael.
and CGT benefits and stuff as well, isn't there, for the listed REITs?
Yeah. Michael Batelka asking, with the increasing inflation rate, what hedges besides real estate and ETFs would you suggest? Are Bitcoin and gold part of everyone's portfolio to hedge against inflation crisis? Well, now you're getting into macro theory, which is probably not our specialist subject, but I don't know if anyone wants to have a go at that.
I would start by sort of the first point here, inflation-linked leases. Okay, you've got real estate, and I do think in a highly inflationary environment, we really will see rents push on, irrespective of whether the lease is inflation-linked or not. Notwithstanding, actually, you might lose from that to the extent you won't capture the market rent. I've only got sort of a personal view on the Bitcoin point, which is hold a very small amount personally as part of a wider portfolio and diversification. It's a very small percentage, and that's just sort of more fear of missing out. Yeah. I certainly wouldn't be linking it to sort of an inflation crisis. I mean, what you could say is and I think there is a bit of a risk associated with hyperinflation and just the sheer amount of stimulus that's been pumped into the markets. Is that associated with retail investors buying Bitcoin because they've got spare cash kicking around? But to me, it doesn't feel like an inflation hedge. It feels more like a very speculative sort of, not boom and bust, but certainly, quoting the obvious, it's so volatile, isn't it? And people can see that. So, and I also think you see an element of that in the SPACs as well. In the SPAC companies that have raised so much money and trading at these huge valuations and made ridiculous gains of hundreds of % within a 3 to 6 month period, and a lot of them have crashed. So instinctively, it feels more like a bubble as opposed to an inflation hedge. But I'm not an expert.
Very well handled, Dean, I think. But maybe one last question. This is from Jose Ramon Mariategui. 3 tips on buying logistics property. I suppose that means direct rather than indirect, but I suppose however we want to answer it, really. Tom?
Use DTRE.
Rather than CBRE. No.
Location.
Make sure you get your PI.
No, I hate to say location, but it really is everything that underpins pricing in the logistics market. I think you want future-proofed spec. I don't know what that exactly means, other than what Dino said in terms of good yard space and good eaves, because cubic capacity and throughput are becoming more prevalent from an occupier's perspective than ever. Base it off off sensible fundamentals. Be buying something off a sensible base rent where you see there's not an oversupply of competing space, and you're going to get solid rental growth. That's what's driving performance.
Yeah, I just wrote the 3 things down here. Site area, underpinned by good alternate use value, and the third one being in a heavily land constrained area, which will in my view put you in good place for upside outperformance through rental growth and good downside protection. But there's a lot of money chasing that strategy.
Yeah, it's not going to come cheap. But no, absolutely good advice. I think we've come to the end of our hour, gentlemen. So thank you very much for all your fantastic comments, contributions. I hope we've covered everything that that the audience was looking to hear, and we'll leave it there, I think. Darish, was there anything else we needed to say before we sign off? If not, we should probably sign off, gentlemen.
Good.
Thank you very much.
Cheers.